All right, guys. Well, good morning. I want to welcome everybody to the open forum. Today's host, again, week 5 of the 6-week series, is Jason Pughe with AmeriFirst. Michelle with AmeriUno wasn't able to be here today. She's out of town on vacation. So Jason will be taking over. And Jason, thank you for coming again today. Thank you for this series. It's been very good. I forwarded everyone the attachments that you sent me for the tools. Maybe if you can explain those a little bit, and then get into today's speaker and explain what he'll be talking about as well. Thank you for coming, and I'll turn it over to you.
Yeah, thank you. So basically, this video is about 30 minutes long. It's with Barry Habib, who a lot of mortgage people use and financial people use to really forecast interest rates and things like that. He's won the Crystal Ball Award, which I guess is their forecasting award. I think 3 times. I'll talk about it in the video, but I think 3 times in the last like 4 or 5 years. And there's different people that are up for that award, like from MSNBC and other financial networks and things like that. So from what we've seen, he typically is the one that gives us an alert of daily alert of when we should lock in, if you should float, if you should, just what to do. Hey, this is going to be the Fed's going to speak today. Right now we've got over the next 2 days, I think some announcements that could shake interest rates up a little bit. Yesterday they went down, or I'm sorry, went up. This morning they went back down. So we get these daily alerts, and he's a good resource that we use and that a lot of people use. So within his website, we use some tools, and I sent those items to Ryan. I was helping a client, a realtor client in Brandon, Tampa area. And we had some different things like the cost of waiting analysis, the bid over ask, depreciation results. There's also like a report card that'll give you the schools, the crime, things like that. So there's different tools that we have through that I've had a lot of realtors say are beneficial. And like I said, Ryan showed you those items. The biggest thing right now is kind of the cost to wait. You can also do, the bid over ask is also huge because, as you know, a lot of homes that are going under contract, if it's 300,000, there's bidding wars up to 330,000. So your client's going to want to know, if I go in over ask on this, when's it going to be the right time, or the amount of time that it's going to take for me to essentially make my money back. So these are all useful tools that we have. I'm going to go into this video right now. It's 30 minutes just to kind of give you some highlights on what his outlook was for 2021. And then even for 2022. And then, if there's any questions after that, we can go from there. All right.
Okay, we are live for Momentum Monday on Monday, March 29. Holy cow, we're spring, and in most markets where we are, the weather has been pretty decent as of late. Hopefully, those in the middle of the country have worked through all the storms that passed through there Friday and Saturday. Pretty nasty in Nashville and surrounding areas. We have a very special treat. Our good friend and partner Barry Habib will join us here in a couple of minutes, and there he is. He's going to join us in a minute. I'm going to give it a few more times because we're going to have a big crowd here today. I want to make sure everybody gets in that wants to get in. But I want to tell you, I got to do this with the booklet here. Hang on. How do I? There we go. Money in the streets, and we're going to find out if there's still money in the streets here from Barry in a minute. But for a few lucky participants that asked some questions throughout the show today, I've got a whole bunch of these signed books that we're going to pass out and share with all of you. So with that said, let's get started with today's not readiness preview. We're going for Momentum Monday today. And we are using Zoom. And in the event we get Zoom bombed, Jessica will be kind enough to shut this down for us. Questions, as I said, are welcome. And for those a select few, we'll get a signed autographed book of Money in the Streets that Barry's got behind him. So welcome into our very good friend and unbelievable partner. We have Barry Habib. Great to see you. Thank you so much for joining us in these crazy times. We thought 2021 was going to be a whole lot better and different than 2020, and it's starting out a little chaotic for us all. What's going on?
You know, there's a lot of good there. There's a lot of good things going on. So first of all, Craig, thank you. Appreciate you and your friendship, and you know, it's great to see you and Doug and Ron, Mark, and both Rons, actually, I should say. And Jessica, thanks for doing all the stuff that makes it easy for us and making us all look good on here. So appreciate you. And all my friends at AmeriFirst, it's so great to be with you once again. You know, I've enjoyed times where we've had some calls together. We went through some hairy moments together in 2020. We came through it okay, maybe better than okay, hopefully. Hopefully you and your families are all good. But now we're in 2021 and we're coming up to the close of the first quarter already. I don't know where the heck the time goes, but it just seems like it just accelerates each month, each quarter, each day. But what we want to try and do now is make sure that 2020 isn't something we look back on and say, oh, well, it was a good ride while it lasted. You know, 2021 can be pretty amazing. When I was originating loans, when there was a super hot market, it was great. We all enjoyed it. But sometimes I couldn't help but feel this way, that, man, you know, I felt that I put so much effort and work in to improving my skill set, and I didn't know that it was shining as bright as it really should have, because it seemed like everybody was doing well, even some people that were less experienced or maybe less knowledgeable, that didn't put in as much effort, and they were doing extremely well. But it's times like this where things change a little bit, that the great company that you're with, the great leadership that you're with, all the effort that you put in, that's when you can really shine. And right now you can really shine. It can be great. Now, it's not without points of friction. You know, the purchase market, it's hot, but it's difficult. You know, it's something that we always have to sharpen our skill set in order to remove points of friction. The refinance environment, there's still a lot of people that can benefit, but they either feel butthurt or they're in a position where they're waiting for rates to cycle back down. And we have different areas that we need to focus on, but we can still do amazing numbers in this environment. So let's get started. It's great to be with you because I think you guys understand a lot of the concepts that are out there. And I want to talk to you about where interest rates are, where they're heading, and how we can win in this environment and win in a big, big, big way. So I'm going to share my screen. Let's start there. And I'm going to start by looking at where the interest rate environment is right now. So you can see we're down 11 basis points right now on mortgage-backed securities. We're not really in a position to worry yet about a reprice, but I'm not loving the way the market is. Look at the 10-year up to 171. Now, you bet you guys hopefully are watching the daily updates every day, because we did say, as we look at the 10-year here, it looks like we're moving up towards 175. And look, if you remember on Thursday, when everybody thought, okay, the market's doing well, we told you guys to lock in on Thursday. Why? Because we said we tried to get past 160. We couldn't get below 160. And because of that, we thought that we'd probably wind up drifting up towards 175. And everybody was on CNBC saying, oh, rates are going lower. You now have the great David Tepper saying, oh, rates are going to go lower and this and that. It seemed like we were the only guys that disagreed with it. But sure enough, things have gone now from 160, as you can see, to 1713. And I think that there's a good probability that we gravitate towards 175. Now, let's hope we stay in this range, because the news I'm going to start off with, and I'm going to explain why, is that over the next few months, you're going to see rates go higher still. I want to talk with you about that, and I want to tell you about what strategies to employ so that you can continue to win. We take a look at mortgage-backed securities. Now, mortgage bonds, this is where it's kind of gotten ugly here in pricing, the pricing that we've lost. Now, you know, if we go back to December, you know, we did a rate lock alert in December that was right at the top of the market. We didn't lock for 5 weeks, and then we did one on January 5th. again, right at the all-time highs, and then right here back in January 28th at the all-time highs. And then sure enough, as prices were declining, you see many, many rate alerts that we've done. Now, here's where we thought we'd kind of land at a floor. We didn't quite land at a floor until the next day when that 7-year note auction surprised us. But of course, we were pretty well protected all the way down. And then we couldn't hold this level here, and we've gravitated now towards this floor. And as you can see today, we're breaking underneath this floor. I don't like the way this looks. It looks to me that we are more than likely going to get back down towards this floor. So I think we're going to lose some pricing here. And you can see it's already started. You know, so it wouldn't surprise me if sometime today, maybe sometime during this call, we're going to have to think about doing an alert to lock in. I don't really like the way the market is trading at all right now. But let's take a quick look at where we are and some of the factors that are surrounding us. So first of all, the stock market, it is pricey, but it is being held up by a lot of this stimulus that's out there because a lot of it's finding its way into the stock market. Deutsche Bank and Goldman Sachs did studies that say 60% of the stimulus checks are finding its way into the stock market. Now, look, I don't want to get philosophical on this, but my question is should we be doing stimulus so that people could play the stock market? I'm not so sure that that's what the stimulus is intended for. And look, it's a great idea. I love helping people, but it's not without a cost. The debt that we're getting into is just unbelievable. And that's going to result in much higher taxes for all of us to pay. John Templeton, one of the greatest investors of all time, said that bull markets are born on pessimism, grown on skepticism, mature on optimism, and they die on euphoria. And the market's quite euphoric right now. You've seen us talk about this in the updates. The Citigroup Tonic Euphoria Index, a reading above 0.41, says we're in euphoria. And if you look at where we are today, we're way above that. And you could go back to any time we've gotten above 4.1, and it's been very rare. The market's pulled back. And sometimes not only has the stock market pulled back, but it's led to recession, recession, recession. Here, we of course have the recession here. But our euphoria index is here. Here's where the dot-com bubble burst. Here's where the markets crashed in 2007, 2008. So we're at, we don't even have a measuring stick for the high levels that we're at right now. And we go back to Joe Kennedy, who forecasted the stock market crash when he thought that because the Shoeshine Boy was in the market, that everybody was in the market. People were too euphoric. He thought the stock market was going to crash in 1929, and he was right. And today's version of the Shoeshine Boy is all the people in Robinhood, these inexperienced investors. So do we think the stock market's about to have a major pullback? It's possible, but the euphoria is being maintained by a lot of this stimulus. One thing we do know is that it does wear off. And when the stock market does pull back, chances are you'll see a big improvement in the bond market. Now, the reason why we have to think about the bigger picture and the longer term as well as the shorter term is because the impact debt has. So you all know this, and you guys are a lot smarter than the average mortgage professional out there. We've gone over stuff like this. You know what drives interest rates. What drives interest rates is inflation. Inflation is that driver. We've talked about this before. I've used the example. If you gave me a mortgage, I'm paying you $2,000 a month. You use that $2,000 a month, and it buys a shopping list of goods and services exactly worth $2,000, and you get the same list next month, the month after, the month after. But over time, inflation, even though it's gentle, it does cause prices to rise, which means that you cannot afford everything on that list anymore. So you have to leave some stuff off. So what's happening is your buying power is being eroded. It's the same $2,000 a month. It's just not buying everything. So you can't do anything about the loan you gave me if inflation starts to rise over time to a faster rate. But what you start thinking about is on the future loans that you're going to do, if your buying power is going to be eroded faster, then what you probably need to think about is offsetting it by starting at a higher perch, which means you have to charge a higher interest rate. And that's why when inflation is either anticipated to rise or starts rising, interest rates go up. So right now we haven't seen the hard numbers of inflation rising. It's all anticipation of it rising, but that's why you've seen mortgage rates move up roughly 0.5%, because we think inflation is about to rise. And we're right, inflation is going to rise. I'm going to explain it to you in just a minute and its effect on interest rates. So this is all important for us to get, because what drives inflation is economic activity. And debt is like a weight on economic activity. It's just like that family that wants to go out and buy a nice car, and they want it now, so they use debt so they can get it now. And when they make the purchase using debt, using credit to make the purchase, it creates a spurt of economic activity. You have the manufacturer, the dealer, and the salesman all make some money from that transaction, and they go out and they create some economic activity, but it wears off pretty quick. And what's left behind is that family now for the next 5 years has $1,000 a month less or so that they can use for economic activity. So it acts as a drag in the long run, spurt and then a drag. And that's what we're seeing right now when we see this push of stimulus creates economic activity, creates inflation. But then as that wears off, now we don't know if there's going to be another infrastructure deal that we see $3 or $4 trillion, so crazy, right? We don't know if that's going to happen, but without that, over time it'll wear off. If you remember last year, the CARES Act was in March and April, 2.3 trillion plus 500 billion. It totaled $2.8 trillion, a huge number and a huge spurt of activity. But by October, it wore off. In December, we got 900 billion. In March of this year, this month, we got another 1.9 trillion. Coincidentally, that same 2.8 trillion number again. If we follow the same playbook without additional stimulus, perhaps by October, this wears off. And you should start to see both interest rates cycle down, economic activity slow down, and you should see interest rates move back lower. Now, the caveat here is, do we get a $2 trillion, $3 trillion, $4 trillion infrastructure package for stimulus, and that kicks this down the road a little bit further? But eventually, when it wears off, we're going to see a recession. And that recession is pretty much inevitable. You know, we called the recession when I was with you. We told you that you're going to see a recession in 2020, beginning of the year. And sure enough, we got it January 31st before all the lockdowns. And we said that interest rates were going to go lower. And remember, when I remember when I was with you in March of 2019, I said, don't do any loans with upfront MI. Take monthly MI to the extent you can, because there's a breaking period. You're not going to have this in long as a year or so.
Furniture as collateral, because obviously
higher rate and have less fees, since there's typically,
so
depending on
they
the
won't
specific
include it.
support,
So what a lot of agents do
3 or
is,
4
yes, they
year
hope to
break-even
draw a
period,
separate
or
fund,
5-year break-even,
either assign a price to it, and that doesn't
and that was
get
very good
included
advice.
in financing.
See what I'm telling you?
Or let's say
The
it's
same thing is about to happen.
the dining room
2022,
set.
2023,
So what they do
you're going to
is
have a
they put it
recession.
on the
You're going to
addendum.
have
They
very, very
say
low rates.
buyer and
All
seller
the loans you're doing today,
states
about
that
3%, are going to be
it's
refinanced.
minimal
So
value.
you're right now, what you're doing is you're planting the seed
$100, and then they won't get the lender.
tomorrow.
But ask your lender for what the guidance of what their underwriting
Let's take a
requirements are, and then you won't have the problem later on. Okay, are we going to touch on escrow addendums and how to handle them? Yes, we will, but next month during addendums. Are the mirrors in the bathrooms considered fixtures? Yes, if they're
not going to have this loan for 3 or 4 or 5 years. And that was very good advice. Team, what I'm telling you is the same thing is about to happen. 2022, 2023, you're going to have a recession. You're going to have very, very low rates. And all the loans you're doing today above 3% are going to be refinanced. So you're right now, what you're doing is you're planting the seeds for tomorrow's refinances. All right, let's take a quick look here back at the slides.
Hang on. Before you do that, I just wanted to show something here. Well, no, let me grab something here, Barry. I'm going to tell me what this is all about.
Oh, wow. Yeah. So thank you. So I did a couple of weeks ago, I did get notice that I won the Crystal Ball Award again. Nobody had ever won it twice, but I now have won it 3 times for 2019 and for 2020 for having the most accurate real estate forecasts in the country. There's 150 economists, and some of them are very big. You know, you've got Goldman Sachs, Wells Fargo, Morgan Stanley, and some smaller folks, but I was extremely, extremely honored that that we won it. And listen, I give the credit to my team, and I give the credit to you guys too, because you guys have helped by every time I came out to talk with you and telling me what your local real estate market conditions are. It really helped us get a jump on and get a more accurate read. So we all share in this together. This is something that belongs to all of us, because if it wasn't for you, there's no way that we could have come up with the forecast that we did. So thank you, Craig. That's
Yeah,
very nice.
congratulations.
Well, thank you. It's a big honor for all of us, and I appreciate you acknowledging that. Thank you so much, brother. So let's go back and take a look here. And we talked about debt slowing growth. How much debt do we have? Well, right now we've got 28 on its way to 30 trillion. Who knows if it's going to be higher than that? And that's going to slow growth down because you have to raise taxes. That's going to slow growth. And you know, when you talk about trillions, we often are immune to it because the word trillion has lost it's just shock and awe. But it really is an enormous number. If you said,
Thursday,
okay,
random
spend
Thursday,
$1 million a day, every day,
7:59
7
on
days a
Thursday
week,
PM.
it
But
would
if it
take
runs
you
on Sunday, your
2,700 years to
deposit is
spend $1
now
million
due
a day.
4/59 of the following Monday. So, okay, if inspection shows no problems, can the buyer still get out of the contract and get the deposit back? Well, maybe if they do it out of
Every day, 7 days a week to reach 1 trillion. You would have had to have started in 700 BC. You still wouldn't get to $1 trillion today. And the reason that we look at this is because, as I mentioned to you, that debt, we use the example of the family now having $1,000 a month less, but an economy feels the same way. In the United States, you go back to the 1950s, when our debt in pink goes down, there's more money for economic activity. It generates growth, it generates inflation, and in turn, that inflation pushes rates higher. As our debt rises, less economic activity because there's less money, lower inflation, and in turn, interest rates decline. Debt goes up, rates drop. And it's the same everywhere in the world. It's the same in Germany. It's the same in China. It's the same in France. You can see it's the same in Japan. It's the same in the UK. It's the same in Italy. So this is everywhere in the world, same story. We get the exact same picture everywhere you go. So we know that this debt is going to cause rates to decline. We know that there's likely a recession over the next couple of years that we will be seeing, and that means lower interest rates for us. The rates are going to remain attractive, but it's a rocky road ahead. And here's the thing, is that when we look at this rocky road ahead, we know that the administration has increased the supply of treasuries to be sold because we don't have this money where we have to borrow it in order to write all these stimulus checks out, which means that people like you have to buy treasuries. And maybe you're not realizing that you're buying them directly, but if you have mutual funds, 401ks, IRAs, insurance policies, some of your money is invested in treasuries or in mortgage-backed securities. So we are having to be incented to buy this paper with a higher interest rate due to the fact that there just isn't enough demand at those lower levels of interest rates to sop up all of this. So rates are going up because of more supply that's out there, as well as the inflationary fears that people are thinking. So rates are likely to bump higher before they resume a downtrend, and inflation fears are pushing interest rates up. So we talked a lot about inflation. Let's understand how inflation works. Now, the first thing that I want you to really understand is that your customer's psychology here is one where they can act a little butthurt, they can act like spoiled brats. Look, everybody wants the lowest rate out there, you know, and they're going to be like, oh no, I want 2 3/4, you know. If they were saving, I don't know, $350 a month at 2 3/4, and maybe today they could save $275 a month, it doesn't mean it's a bad deal. They shouldn't be spoiled brats about this. We have to calmly explain to them that if you're waiting for it to get back to 2 3/4, there's no guarantee. You might get back there. In fact, we think that if there's a recession, who knows, we could approach those levels. We think they will cycle back down. But 2 things you should know. One is they're going to get worse before they get better because of inflation. And the other is that if it still makes sense to save $275 a month every month this right now, even with rates at 3 1/4, the reason why you should do it is because even if you're right, but it takes 10 months to get there or 11 months to get there, that's like $3,000 that you would have lost by not taking action today. Take action today, save that money. If rates don't come back down, you really were smart. If rates do come back down, then that incremental $75 a month would take a grand total of like 4 to 5 years before you got just back to even. So do you really want to wait 4 or 5 years on a potential to maybe start saving an extra $75 a month 5 years from now and beyond? Or would you rather start saving the for sure $275 a month now? You sometimes have to talk them off of their emotional outrage of, not getting that lowest rate in history, and remind them that it still makes good common sense to do this. And the reason why we think rates are going to go higher is because inflation's about to rise. Now, when we talk about the rate of inflation, we like to look at the core rate. That strips out food and energy. So you got the headline, and then you got the core rate. And if you look at the consumer price index, that's pretty widely viewed as a good inflation gauge. The core rate strips out food and energy. And then some people will say, well, wait, I need food and I need energy. Why are you stripping them out? Because the Fed wants to look at things that they can influence. The Fed can't influence if a tanker gets stuck in the Suez Canal, causing oil prices to rise with monetary policy. The Fed, with monetary policy, can't influence if there's a drought. So they look at the core rate because these are things that the Fed can influence. And when we take a look at that, the rate of inflation on a year-over-year basis is 1.3%. Now, how do we get to 1.3%? Well, you look at each month's inflation for the most recent 12 months, and you total them all up together, and it totals 1.3%. But what you'll notice is that the most recent number is February of 2021, and it goes all the way back to March of 2020. Now, in the second week of April, we're going to get the number for March of 2021. And when we get it, we're going to replace March of 2020. So let's make an assumption, because you have to make an assumption. We got to put a stake in the ground and build a model. And I think it might be a little conservative, but I think we'll see probably at least 0.2% per month inflation, especially with all the stimulus going on. So when we take a look at the number that we're going to get in the second week of April, which will give us the reading for March of 2021, we're going to replace March of 2020. We're going to replace 0 with positive 0.2. So that means this number is going to go from 1.3, and you could do the math. It'll go up 0.2 to 1.5. Not too bad. But then look what's going to happen the second week of May when we get April of 2021's inflation and we replace April of 2020. That's going to be going from negative 0.4 to positive 0.2. You can do the math. That's going to start to raise a lot of eyebrows when inflation goes to 2.1% year over year from its current 1.3. And then it gets worse. In May, the inflation that'll be replaced, and we're going to get the second week of June, will push it to 2.4%. So let's review. Right now, inflation is 1.3, and mortgage rates are starting to rise based upon the anticipation of inflation, but they haven't risen as much as inflation is going to rise just yet. So here you see in April, it'll go to 1.5, in May, 2.1, and in the summer, you're going to be at 2.4. So if you're offering a mortgage rate today at 3.25 with 1.3% inflation, I promise you, you will not be offering a mortgage at 3.25 with 2.4% inflation. You more than likely will be closer to 3.75. Could it be a little bit higher, a little bit lower? Sure. And there's other factors to contemplate, but it's not going to be 3.25. It'll be higher. And that's why you need to tell your customers to get off their emotional ride here, stop crying, and take advantage of what they have. Look, people always make the wrong comparison. They compare what they could have had to the rate today. But the fact of the matter is you just can't get what you could have had. Your true choice is the rate today with what the rate will be in the future. So you can either pick today's rate and choose that over the rate in the future, or you can pick either one, but you can't go backwards and get the rate that used to be. So knowing that, we believe that there's a very strong probability that the rate today is going to be a lot better than the rate that they may be crying like a baby over 3.25, how ugly it is, but believe me, they will be begging for 3.25 come this summer. So it's a few months away. They'll be begging for 3.25 and they won't be able to get it. So what we have to do is we have to explain that to them and see the future and explain the future before it becomes obvious. Now notice in the fall, they're going to cycle back down. We believe that there's really good reason to believe that they'll come back down in the fall, but then they could potentially get a lot better in 2022, 2023, when inflation slows down, when economic activity slows down, and when there really appears to be signs of a recession that we'd already be in if it weren't for all this artificial stimulus that we've got. Now, the inflation is going to be transitory, like we said, And this is an interesting way to view this. People don't go this wonky or this deep, but follow me because I think you'll find it makes a lot of sense. The all-in unemployment rate is 11%. Forget the 6% that you're seeing. This is people that wish they could work full-time, but they got to work part-time. People that aren't being accounted for because they're discouraged or they haven't looked for a job in the last 4 weeks. If you really take a look at the unemployment rate, it's 11%. And it's important to look at that because inflation from the labor market accounts for 75% of all inflation. Now, a big portion of the other parts of inflation come from capacity. Think about it like this. When you guys were like at crazy capacity levels and you guys couldn't even breathe, margins tend to expand. When mortgage companies are slower, margins contract. So that's capacity utilization. So the factories in the United States are only at 74% capacity. So they don't really have a lot of pricing power because if I try and raise prices, you'll go to somebody else who will take you on as a customer gladly. In fact, you're seeing a lot of discounts where people say, hey, look, I got a factory. It's open here. We need the work. Send it our way. We'll give you a break. Normal capacity is 78%, and you don't start to see inflation until you get in the 82, 84% range. But when we look at the ratio between these two, which a lot of people don't do, and I want to show you an interesting formula here. If you take the capacity utilization and divide it by the employment rate, so you take 74 divided by 11, the ratio of the employment rate to the capacity utilization rate is 6.7 times. Normal is 8. During COVID, it was 11. That was when inflation was at 2%. So we think that the economy is much weaker than people are estimating. We think inflation is much less than what people are estimating. And unless the unemployment rate drops dramatically, which we don't see, or factory capacity rises significantly, which we don't see, this inflation is going to be transitory. It'll be temporary. And that means rates will cycle back down. Now, here's something that a lot of people are struggling with, and you should use these charts. And this shows mortgage rates for the past 40 years in blue and the Fed funds rate in red. And what I want you to notice is not just that 40 years ago, we were 18% mortgage rates, but what I want you to notice is the relationship between the two isn't in lockstep. You get a lot of times where the Fed funds rate goes up, mortgage rates go down. That's because it's perceived the Fed's fighting inflation, mortgage rates like that. Or the Fed funds rate goes down, loose on inflation, mortgage rates go up. And you see this pattern over and over and over. But notice even here, when the Fed was like they were for 7 years at 0. Now the Fed's at 0 today. So people say, hey, wait a minute, the Fed's at 0. How can mortgage rates go up? Well, if you remember, I showed this chart quite a bit at the end of last year, and I said we're about to go through one of those periods. And here's a couple of them. Well, the Fed was at 0. Here, in 3 months, we went from 4 1/8 to 5 1/8, up 1%. In about 5 months here, we went from 3.5 to 4 3/4. And this was a pretty big move at the time that you might remember. And we see it over and over again, but we're about to go through one of them now. While the Fed's at 0, we've seen mortgage rates go from, let's call it 2 3/4 to 3.5, 3 1/4, but it'll probably, before it's over in the next few months, go to 3.5 or 3 3/4. So in about a 5 or 6 month period, we'll likely see that 1% bump like we've seen before in mortgage rates, even with the Fed at 0. So this is coming, and you have access to this. And look, team, when I spoke to you in 2019, I know everybody thought I was nuts for some of the calls you're making, but I'm bringing you behind the curtain. I'm showing you all the things we look at so that you could see these models work. And I remember when I went on Fox, I went on CNBC and Fox and a lot of them because everybody brought me back after saying, okay, Barry, you were right. Treasuries went to 1%. Where are they going now? And when I pulled up this one, because if you pull up the clip, they said, when I said they're going to 0.5%, nobody believed me. One guy yelled at me and said, I want to debate you. That'll never happen. You're crazy. Pull up the clip. And sure enough, it went to exactly. This is the all-time low of 0.5%. So we dialed it in exactly. I bring this up to show you because this type of logic works. And most people don't see it. Most people don't realize the impact that debt has and the factors that we use, these formulas that we use to determine where we're going. Could it be that it doesn't work this time? It could be. Nothing's guaranteed. But I will tell you that I'm confident that in the absence of stimulus, that we're going to probably see a really meaningful drop in interest rates. I don't know if we had all-time lows or not. I'm not saying we do or we don't. But again, these 3% rates are planting tomorrow's refinances is really what they are. You should come back down below 3%. That's probably a very likely scenario for us. So still, I would think about today, maybe don't do upfront MI, do monthly to the extent you can. Don't do points, do 0 points. And if you can reduce fees and take a higher rate in exchange for that, I think it's a smart move. And you really need to use debt consolidation, team. This is
All right. Yeah. So
really the golden goose right now.
So the rest of it, he goes into the refi side. So that's more for loan originators and doesn't really apply here. But I'll kick this back to you, Ryan. I just thought, that outlook. I've had different realtors who have said to me, that they have certain clients that, whether it's new construction, whether it's trying to consider rent or buying. Had one with new construction that he did not want to get a new construction because they wouldn't let him lock his rate in, and he was concerned about the rates down the line. So having that information and at your disposal, I sent that to this particular realtor. She showed him the video, and he was able to kind of get off that line of thinking. So hang on, Ryan. Let me get this over to you. Where is Ryan? All right.
Fantastic. Guys, a lot of what we do is sales, obviously. That's our job, right? So we're going to have objections. And a lot of the objections you guys are hearing is it's a terrible time to buy, or you hear I'm going to wait it out or anything. And as you guys know, waiting it out, you want to keep those people in your pipeline and stuff, but waiting it out is a good way for them to find something on their own, meaning they find it through another agent. Keep all these things in mind. These are great. The things that he sent you are great tools. Jason, I know they're gonna have some questions on some of these tools. I know I have a few, but I'll let them ask. What kind of situation do you find yourself using these tools, and how did you help this realtor in Brandon?
So this particular realtor had a client that was selling their home, and they wanted to see, is now the right time to sell, and if it is the right time, is it the right time to sell and buy, or is it the right time to sell, rent, wait it out? I think the common thing that I hear from people is, it's so crazy right now. I think I want to wait till it slows down a little bit. And I think people think there's going to be this big bubble that's going to burst, like back in, the early 2000s, to where you're going to see short sales and, $300,000 homes be worth $170,000. And, I think the big difference between then and now is, there's no inventory right now. Back then there was tons of inventory. So I always try to tell people, I do think it's probably will slow down from the perspective that I don't think there's going to be hyper appreciation to maybe the level that it is now, but I do think there's going to be appreciation still. So your cost of waiting is still going to be, if I'm not buying right now because I want to wait for it to slow down, well, yeah, maybe won't appreciate percentage wise, at a higher level, but it's still going to appreciate. So you're still, there's still the cost of waiting a year from now. So that's what I try to tell everybody is that I talk with. I was speaking with somebody the other day. He wants to sell his home, and he was, should I rent? Should I go ahead and buy? And it's just, I think a year from now, it's going to be a higher price than what it is if you bought today. So kind of using these tools to show those different scenarios of, if I'm selling a home, here's why I should buy right now. If I want to buy a home right now that I really like, but I'm concerned that if I spend $20,000 more than the list price, is it a good investment for me to do that? Because I'm going to be in this home for 7 to 10 years, 5 years, whatever it is, to get that appreciation back. So that's really where I'm using a lot of these tools, is kind of to help the realtors convince just the clients that they have, is it the right time to sell? Is it the right time for me to go all in on this property that I really love because I'm going to be there long term? So, I think there's a variety of different scenarios that you can use it for.
Fantastic. One of the ways to look at this, and I know people are scared to death of being buyers because, You guys are all posting memes on your Facebook about how terrible it is to be a buyer right now. And oh my gosh, we finally got our offer accepted. And when you sell one, you're posting about how you got $40,000 over asking price. And so buyers are scared to death. And they are, they don't want to be battered around out there and taken advantage of. And, you know, there are certain motivating factors in life. And one of them is the fear of missing out, as we call it nowadays, which is what we call the hope of gain. And then there's the fear of loss, which is a stronger. So the fear of loss is stronger than the hope to gain. And so these people really have a fear of loss. They don't want to feel like idiots. They don't want to look like idiots. They don't want to be out there buying right now. But one thing you need to tell them is explain to them, look, yeah, if you're selling and then buying, you're kind of just refining into a house you'd rather have, first of all. And second of all, you're going to be battered around a little bit as a buyer, but we're going to batter people around when we sell your house. When we list your house, we're going to get the advantage. We're going to say, hey, you know what? We'll close August 1st, but we're not leaving until September 15th. You know, so give yourself time to go buy a house. So you can push people around as much as you're going to get pushed around as a buyer. You could equally push them around as a seller. It doesn't matter if it's a seller's market or a buyer's market or a flat market. You're going to get the same deal as long as you take advantage of the side where you have the strength, which right now is on your listing. So, you know, look, yeah, we're going to get pushed around as buyers, but we can push people around as sellers. You're worried about the timing because you don't know if you're going to get an offer accepted. Well, guess what? When Natalie brings her client to buy my house, I'm going to push her around, right? Yes, Natalie, I am. And so yeah. And then when I go to buy Daryl's house, Daryl's going to push me around, right? So that's the way it works right now. But in a flat market, it's so funny. I was looking this morning and they had some meme, some realtor had a meme of yay, we got our offer accepted. And, you know, it's a common meme, but you guys have probably seen one very similar. And that feeling you get when your offer gets accepted and all that stuff. That's funny because it's going to show up on her memories in about 4 years. And she's going to be the same day she's posting, finally got someone to look at my listing today. Yay, I had a showing, right? Or however long it's going to be, it's going to show up in her memories, and it's going to be the exact opposite, you know. So it's just funny that how this market works. But be sure that you are explaining to the client, look, yeah, sure, and you're going to be someone out there fresh that's explaining this, because a lot of people aren't hearing this. Yeah, you're going to get pushed around as a buyer, but we're going to push people around when we sell your house. Okay, we're going to get you time, guys. Take advantage of that. Some of you guys know I sold my house. We closed on June 2nd. We are vacating the house tomorrow, July 15th. Okay, sold it, got 6 extra weeks to get all of our stuff out of there and do everything we needed to do. So guys, take advantage of this market on the seller side, right? Gives them time, make them feel comfortable. We can get you time to stay in the house, have your money, buy your new house, and slowly move your stuff over, or in case we don't get a house right away, gives us time to get that done. You can push back closing dates. You can make closing dates with set periods of occupancy afterward, and the buyer doesn't have much choice, unfortunately. So these are all ideas and things that you guys can use and seeds to plant in your client's head of why this is okay to do. Because like Jason's saying, most people, Jason, I know you guys have been doing tons of refis. Everybody has been doing tons of refis. People are in loans that they've had these houses for 10 years or something, and they're in at 4% or whatever they're in, which was a good rate back then. Those of you guys that have been around know that it's still a fantastic rate. But now they can go get it 3% something, and they can go, instead of refining their house. I know a lot of you people have gone, I don't know whether to sell or just refi what we have. Let's go get you the house that you actually want, right? It's been 10 years. You want another house. The kids are off at college, or maybe you've got more kids than you used to have, or whatever it is. You need a bigger house, a smaller house. You say, you know, your guys are empty nesters now and you want to live near downtown, or whatever it is that they want to do. Upgrade their house, and they're essentially refining when you do that. So their house, yeah, they're going to pay more for a house now. Guess what? They're going to get more for their house. Yes, they're going to get not as pleasant terms when they buy, but they're going to get super pleasant terms when they sell. So just make sure that you're getting that across to them that, hey, this is just like any other market. We just have to take advantage of where we are. You know, you guys remember back in those of you who were around 10 years ago, you were buying cheap. Just, boy, I hope we can sell our house. We're going to have to, you know, put a pot of gold in there to get somebody to buy it, right? It's the opposite. So you can make it work. Just get them off the dime, get them going, explain everything's going to be okay. Sorry for that rant, but please continue. Any other questions for Jason? Or Jason, you have something to say?
Yeah, so I saw in the chat that something pop up about a lease back. Just from a lender's perspective, I would just recommend not putting a lease back and giving that information to the lender. Do a lease back if that's what you need to do, but just keeping it separate from the contract to what the lender's going to receive, just because there's certain occupancy requirements that on certain programs they've got to take basically ownership of the property and move in within a certain amount of time. So I've had ones where they've had lease backs, and they just if it doesn't fit into that parameter of what that time period is and the lender sees it, then it's going to have to be considered a second home or an investment property. So I'm trying to think the best way. I'm not saying commit mortgage fraud, but I am saying that, if you have a lease back and things like that, that unless it's specifically asked for or noted in the contract, then the lender doesn't need to receive that information on the contract.
Fantastic. Fernando wants to know if appraisals are controlling the prices.
So I've actually lately, I've had a couple where I didn't think they were going to appraise. Had one on North Boyd Street that was up for $789,000, and actually got an addendum to where it went from 789 to 765, 64. They dropped it like 25 grand. So we didn't give the appraiser that addendum because we wanted him to appraise it off of what the contract price was. And it came in magically at 789. Had another one that came in exactly at, so I think depending on the appraiser, I'm finding that more appraisers are kind of realizing what the market's doing, and trying to find a way to meet those values. But there are other ones out there, old school ones that are just, the comps are what they are. And like I had a condo that came in 108,000 less, because all he had was comps from November and wasn't using, any of the pendings, obviously. So I think it really just depends on the appraiser, but I kind of have seen a shift lately to where it seems appraisers are realizing what the market is doing and trying their best to get towards that contract price.
Okay, we got a question about first-time home buyers. Do you have any programs for them? Jika wants to know, and he knows it's not friendly out there for first-time buyers, but he's curious.
Yeah, I mean, so the best thing is two programs that I always recommend. So you've got the Florida bond program. There's some disadvantages and advantages of the bond program. One is just from the perspective that it's going to put a lien on that house, so that when they sell or refinance, they're going to have to pay that back. It's not forgivable. So there's certain downsides to the bond program, then waiting on the reservation and getting those funds. Also, if they're giving you $4,500, they have a fee built into that. So it's not a net of $4,500. So, if you need that for the down payment, then obviously that's the way to go. What I try to kind of steer people towards from the first time home buyer perspective is if they're making less than a certain amount, which depending on the county, give or take, let's say like Orange County, it's around 55,000 a year. You can do and their credit's good. Obviously you can do, Fannie Mae has a program called Home Possible, Home Ready, to where you can put only 3% down compared to FHA's 3.5% down. It's got a better interest rate than a normal 3% down on a Fannie Mae. It's got a lower mortgage insurance payment as well. So they give you a discount on the rate and a discount on the mortgage insurance for 3% down. And a lot of times, like I had an FHA buyer who had a better rate on the FHA side, but with this program, they actually had a total less of a monthly payment because the mortgage insurance was significantly lower than what FHA had. So it was like a 3 3/4 rate on Fannie Mae compared to a 3 1/4 rate on the FHA, but the mortgage insurance was like over $100 less a month. So it made more sense for them to have the higher interest rate. And then down the line, they can obviously refinance that and get that rate lower. But I personally try to go the Fannie Mae route just because it's, with gift funds, with things like that, it's a conventional loan. They got to take like a 30-minute course online. It's a lot smoother of a process in this environment when you're looking to close 24 to 30 days.
Fantastic. Terrell had a client rant and yell at agents are comping prices too low and manipulating the market. Okay. So some people are crazy. Any other questions or comments for Jason? Jason's happy to partner with you guys if you want some of these. If you want him to do, if you have a seller or someone you need, or a buyer you need to get off the mark and get them some of these things. They're nervous about paying too much, or they're nervous about selling right now. They're nervous about buying right now. Some of these tools will be very helpful. The ones I attached for you guys, those are samples. Obviously, it's not going to help you that house in Brandon unless you have a house in Brandon for 240. So otherwise, it's not going to help you much. But if you want to partner with Jason, just let him know. Jason, put your stuff in the contact box again, in the chat box, please, again. And Jason's going to get us some stuff next week for YouTube, video marketing. So we appreciate that, and we look forward to the final installment, week 6. Really appreciate Jason coming out. And you guys have any more questions, Jason? Do you have any more comments? Anything else you want to tell everybody? Or
yeah, so with those tools, there is a way to put your headshot and information on there as well as kind of a co-marketing thing. So it doesn't have to necessarily be just my beautiful face and information on there. So so just know that there's a way to co-market on it. So if you need flyers or things like that, and there's other tools as well. I mean, depending on the situation, I can look to see the resources that are available on there, and it might fit a whole another situation. So if you've got somebody that, a buyer that's struggling with something or a seller that's struggling with the situation, I mean, feel free to reach out to me and we can try to tailor some data and some documentation to show them to maybe, help your transaction go easier.
all right, guys, we talk about this all the time, but get a lender like Jason, partner with these people, have a team put together where you get, you pool your resources and you do all this stuff. Coming in with this kind of stuff, even if they don't understand it, which a lot of it I understand, I'm very analytical, but not everybody is. They might not understand it, but at least it looks like you did your homework and you have some kind of, you can at least explain it to them. Make sure you have an understanding of it. Go over it with Jason and have some kind of understanding. But you guys need to use your teams and do all that stuff. So fantastic. And yeah, I would definitely at least co-brand and have your picture on it and stuff, even with Jason or without or whatever. So you don't want to distract them with Jason being so handsome they don't get to look at the rest of the page. So you guys co-brand, do this stuff, use these resources, be the best that you can be. I mean, this is your money. I don't know why I have to tell you guys this. Do the best that you can, and try to stay on mute and do the best that you can. All right, Jason, thank you very much, buddy. We'll see you next week.
All right, thank you.
Good work. And hopefully with Michelle, and we'll see you guys next week. Appreciate it, buddy.
Sounds good. Thanks.
All right. Any other questions or comments about for the good of the order for Florida Realty Investments, or any other comments, questions? Tammy's yawning. I love when you guys have your videos on. I love it.
I'm coughing, not yawning.
Oh, is that? It looked like a yawn. Yeah. At least you waited until Jason got off before you did that.
I have a question.
Yes, Mike.
All right. This is out to everybody there. This is kind of one of those feedback from anybody. I currently had a buyer go under contract on a property that has one ID, but 2 dwellings on it. Both dwellings have septic tank and drain fields, not a problem there, but it is zoned as multi-family or multi-residential family zoning. And the question with the buyer, came up, and we actually backed out of the contract, and we're taking another look at it. But the question is that the buyer wants to live in one of the dwellings as a primary residence and rent out the second dwelling as an investment property, and would like to, he wants to properly account for taxes on this. Now, we've gone to planning and zoning at the city of Sanford, talked to a gentleman there, and one day I went there with the wife, and this gentleman said, no, you can't rent out the other property. We only have one address and one property ID. Okay, so things got a little strange with the couple that wanted to buy and backed out. But the following day, then the husband calls and talks with the same person up there and says, yeah, you can rent this place out and claim income, no problem. So the question is, has anybody done anything like this or been involved in this in any shape or way? I guess there's questions on if this person buys it and the homeowner, what type of taxes are they looking for? They want to account for them properly. Is there going to be a question with property tax, since one of the dwellings is a primary residence and the other one would generate income on that? Any feedback, any input from anybody at all?
First off, the only time I've had a rental property that was impacting a sale was because it wasn't separately metered. So that was the issue we had. But the person who was selling it didn't have a lease. It was a family member, and that's how they had dealt with it.
Okay.
Not that that helps, but that's part of the solution.
Yeah, anybody been successful in a variance in something like that, or even tried a variance in a property like that?
As far as taxes, I think that's a question for your CPA on how to handle the taxes for it. Does it have 2 meters?
Water, no. Electric, we're not sure. You're talking about electric meters? Yeah, water, no, we've got well and septic on these, so that we wouldn't have those meters, but there would be electric meters, possibly for the 2 unit, maybe not. I don't know. We'd have to verify that.
Yeah, you need to verify that it has 2 electric meters, because that right there is going to tell you whether it's a duplex or not.
Okay, very good.
And it depends on, it depends on the city itself as far as how strict they are.
Yeah, this is city of Sanford versus Seminole County.
Mm-hmm. So it really depends on the city. Some cities overlook everything. Some of them don't overlook anything.
Right.
So it'll totally depend on that. I would definitely check out how many. That's my first thing I do when I go out looking for multi-units and they're listed as a duplex, triplex, or quad. I immediately look at how many electric meters there are before I do anything.
Okay, very good. Yeah, most in my cases in the back, the duplexes are handled as 2 separate properties most often. I have 2 separate dwellings on this particular property. Comes into question. So panel checking that out is good notice.
It sounds like they're zoned correctly. If they're zoned multi, so they're zoned correctly. I'm not sure. You did still have to check out the meters to see. Ryan, do you have anything to suggest?
Yeah, I don't know why you need a variance if it's zoned multifamily. You shouldn't need any kind of thing.
I don't think he said it was zone multifamily, did he?
Yes, it is. Yes, it's MR1 multifamily residential. Yes.
Oh, okay.
It's all right, Mike. Tammy's been napping over there. So
yeah, I'm yawning away.
So
no problem, happens to me all the time.
Yeah, me too. So listen, the property taxes will not be affected by the use of it if you don't change any zoning or anything else. Property taxes will be affected by the price that is paid for it. It'll be reassessed. As far as the zoning, it sounds like it's fine. As far as the taxes that they will be liable for, Daryl hit it on the head. They need to talk to their CPA. Nothing to do. Nobody in this forum is going to help you with that. And it doesn't sound like you need a variance. So I think that you can, since it's zoned multifamily, you can certainly get another. So they probably didn't. I don't know how the living situation was before, and it'd be hard to see without visiting the property or at least seeing pictures. It does cost to get a setup for electric. So they might have saved costs if it was a family living there, mom and dad with the kids or something living on property, they might have shared electric. But if they have their own electric, getting a new address for it is a post office situation. Should be.
That's what I thought. Yeah. Post office for the separate address.
But but I don't know why they wouldn't have done that already. I mean, you would think that even if it was two separate, even if it was parents and kids, they would have their own mail. But that's who knows? And they would have, you think they'd have their own electric too, so they don't argue about electric all the time. What are we, air conditioning the whole neighborhood? So I don't know. The answer is I don't know. But you're gonna have to figure those things out. But I don't see nothing here sounds like an untenable situation we can't fix.
Okay.
Not we, you can't fix.
Thanks.
Well, and in reality, not even you, your clients. Your job just to give them the information.
Yeah, it's pretty tricky right now, and they're thinking of actually, if we can get some more information through the day, to go under contract again under the same circumstances we had before. And the listing agent's game for it. I just have to talk to the listing agent or give them information to the listing agent and the seller to help take us back on and challenge us again.
Hey, Mike, this is where you earn a living. This is where you separate yourselves from anybody else who doesn't know what they're doing. You give them all the information. You find out the information and you supply it to them. Give them a reason to go forward. Don't let them be intimidated by this. They're going to be intimidated by it. This is not what they do. Give them the information, accurate information. Let them do. You don't have to do everything for them. I don't know, Mike. What's the price on this land?
We're at 567.
Great. Well, then it's worth it for sure. But go out there, get them all the information. In that case, I would do a little more of the work for them than if it was a $20,000 lot or something. I didn't know what you're dealing with.
Certainly.
So make sure you do. You make sure you give them all the information and get them set up. And by the way, treat your $20,000 people just like your 567 people, but there's less to worry about with a $20,000 lot. So get them all the information. Let them do some of the work themselves. I mean, they're going to want to do some of the stuff themselves, but if it comes down to a post office issue, after all the things you brought up about getting variances and dealing with taxes and all this kind of stuff, it's the property taxes are going to go up. I feel very comfortable as a real estate professional telling you that. But as far as their accounting and all that stuff, you don't know. They can talk to their accountant about that. I would think that I don't know why this would be a huge thing. Why would be any different than any other rental income that they would make? But again, not a professional. Have them talk to their tax professional. All right, but if you could break this stuff down for them and let them know that look, it's this and this, and get it down to a couple of things. These are our obstacles. This is how we're going to overcome them. Then you should have a sale. But just letting them think, and I'm not talking about you right here, but letting people think that, gosh, this does seem tough. I don't have any idea what to do, blah, blah, blah. That's going to make them, that's going to give them cold feet. They're going to get out. So give them all the information. Make sure you find out all this stuff. I hope we were of a little bit of help to you, but check out those meters. This is worth driving out there and checking out the meters and doing all the stuff that you need to do.
Very good. Great input, everybody. I appreciate it, Brian.
You bet.
Mike, if I want, we just want to add one more point from the whole family, and you got something fantastic from Daryl, from Ryan, from the rest. One more thing is to help you with the variance, will help you with the thing. I've gone to one of these situations. Get something in that county or within that region, similar if possible, and you can use that as a cookie cutter. If you want to do variances, you want to do whatever you want to do. That's the easy part with when you have to get things going legally.
If I understand you correctly, that would be finding another property under the same circumstances and use it as exhibit
A. The multi, and see if they have the same sort of a scenario, because usually, unless this was built separately by the family, if a builder got in and convinced people to do this, you might have another one somewhere down the road or somewhere in that area.
Yep, good point. Trick is finding it, but I mean, yeah, it's well taken.
Well, on the MLS, just check, multis, and then see within that region what else is there, just by either from the tax side or from the listings that are there currently or sold. That's my little 2 cents to you.
Well, very good. Thank you.
Thanks, Val. Yeah, one of the things you guys, when you
Thank
do
you.
have to go to ask for a variance to county staff or city staff, and eventually ends up at planning and zoning or the city council or the county commission or whatever. One of the things that's great to find is where you allowed this somewhere else. You see that all the time, and they always wilt when that happens. Well, why did you allow Daryl to do this and you won't allow me to do it? Right? And their sense of fairness overcomes, their sense of wanting to be perceived as fair overcomes any other questions they may have about it. So that's a great input for when you need to do that. I don't think you're going to need any kind of governmental help at all, other than the post office and maybe ordering a new utility stub to the property, which is going to cost a couple $1,000 probably. So any other comments or questions? You guys
one
like
more
the
thing I just want to say.
Yes.
Sorry, Ryan. I just wanted to help Mike one more thing. Just call up the utility that is there right now and ask them for this address. Is there 2 meters or 1? They'll tell you right away.
Excellent. Thank you.
All right. Thank you, Val. All right, guys. Any other questions or comments? You guys, everybody enjoy the presentation today? Do you feel like you got something out of that? How do you guys feel about interest rates? Any questions? Any ideas?
I like how he said in 2022 and 23 they're going to go back down.
You like that? Okay. You guys, you never know. Use what you can to draw. Some of you guys might want to watch it again. It's on our YouTube channel. Use what you can to motivate your clients. All right. If it's a good time to buy, that's a good time to sell, and vice versa, right? So be sure to use these tools, guys, and get these people moving. You guys are doing great. Numbers are great. Our closings are great. You guys, as much as you guys complain you can't find anything for your buyers, you're finding stuff for your buyers. So I love it. You guys are working hard to do it, and I appreciate it. You're beating out of a lot of other companies because I don't hear a lot of other people that are doing great. I hear a lot of people that are struggling a little bit. So you guys are outperforming them, and I appreciate that. And I hope you appreciate it when you get paid too. So keep up the great work. Natalie, is there an award ceremony for last year's accomplishments? Natalie, with this Delta variant going around, I'm just kidding. We're trying to put it together. So we're going to put something together for you. Okay. I'm just using any excuse I can get. But we're putting something together for you guys. It will probably be time for next year's awards by the time we get it ready, but it'll be something when we feel like we can gather, which won't be long. People are gathering again. And again, we'll, if folks don't feel comfortable, that's perfectly fine. We'll do the office shots like we did last week as well, or last year as well, where you can come in and just get individual pictures taken as well. All right.
I was just expecting Ryan to say, look out in the mail, you'll have it there.
Absolutely. Hey, maybe I'll just show you guys a picture of your award. All right, guys. Well, thank you very much for coming. We're going to get, all right. Any other questions, comments? We're all good. All right, guys. See you guys next week. Regular time, probably 10:30. And on the 20th, if you guys missed that MLS touch thing, they're doing it again on the 20th. All right. And they have the one this afternoon that Tammy likes to go with your CRM as well. So
Ryan, I think there was an issue. It was Ryan, you couldn't get into the MLS touch because I think the Aura board is not in. So when you pick the Stella MLS, it just circulates it because when you try to log in, it doesn't find a login.
I was able to log in. I think it may have been overloaded, possibly.
Oh, okay, yeah.
Because there's all these people watching today.
Correct, depending on when you got in. Yes, I agree with you.
Val, they should really do these demos by age ranges and have some of us come in later, and take it slower. I said some of us. I'm with you. Me, you, Daryl. We'll be in later.
Hey, I resemble that.
Sorry, Daryl. All right, guys.
I logged in 5 minutes early and had no problem.
Oh, there you go.
Could be the login time.
It's probably, it probably
Log
is.
in time for sure. Yeah, now you hit the nail on the head. Thanks.
All right, Val. Good luck, buddy. I'll
Take-
see you on there.
Take
Bye,
care.
guys.
God bless to all of you.
Bye, Val.